Hi, welcome to this podcast where I'm going to be looking at accrued and prepaid incomes. You'll be doing this after you've done prepaid and accrued expenses, so it should be a relatively easy topic with just a few slight differences. Just looking at the theory that's involved, first thing we need to know, what is an accrued income? Well, that's when a business has earned an income for some reason, but the money yet hasn't been received at the end of the financial year. So it's part of this year's income, and it's going to be a other receivable that gets recorded in the statement of financial position. Prepaid income is where income has been received in advance, and therefore the business actually owes that income back to another company at the end of the year, although it's going to form part of next year's income. And concept that's slightly involved here is the realisation principle or concept. Old terminology is concept, it's now called a principle. And that is that a sale occurs when a customer pays for the goods or an invoice is issued for the goods or service. Right, example of accrued income. Got a travel business and receives some of its income from selling holidays for other businesses. So the other businesses will give it commission or a percentage of the value of the sales. During the year, they've received $18,900 worth of income, but at the year end, it was found, and we'll change that it to an it found that other businesses owed it $1,500. So what we need to do is we need to look at what we're going to do with it. Well, the first thing is let's try and work out how much income should have been received this year. Well, clearly all the amount of money that received in the bank should have been part of this year's income, and what they've also got is some income that was earned that's not yet been paid for. That totaled $1,500. We're going to need to add that on. The reason why we're going to need to add it on is because it should have been received this year. So the key thing is the accrued income at the end of the year gets added, and therefore the real amount of income should have been $20,400. How are we going to actually record this? Well, the thing to think about in an exam is make sure you get the easy marks. We know that we've received cash in the bank, which will be debited in the bank, and therefore we need to credit the income account following dead click. And because we don't know the exact date, we're doing it for the end of the year, we use the year-end date as the date and put the $18,900 on the credit side because it's an income. Okay, and what we're going to do with this balance carry forward? Well, the first thing to remember is it's on the same side as the bank. So it's got to go on the credit side as the balance carried forward because we're going to need to have a total of $20,400 as the income. And the other thing to think about is actually the business is going to have an asset at the start of next year of $1,500. So the balance brought forward has got to be on the debit side because they're going to be owed $1,500 on the 1st of July 2015. So balance carry forward on the credit side, on the same side as the income because it needs to get added to the income. That means that the totals now are going to be $20,400, and therefore the amount that's going to appear in the income statement for commission received is going to be $20,400. And that's the same as we calculated up above. Okay, we can make the scenario now slightly more complicated if we look at the second year of this business. So if we remember, okay, they were owed $1,500 at the start of the year. During the second year of this business, they received $20,700. Okay, and at the end of that year, they are still owed $2,100. So what we're going to do is we're going to owe the amount owed at the end of the year. We're going to add that on again. Okay, but what we need to do is to do another adjustment for this amount of money that they were owed from last year. And that gets taken off because part of the $21,700 in the bank will have been this $1,500 that should have been included in last year's income. Okay, so the real amount of income for this year should be $22,300. So let's just have a quick look at the T accounts. So with the T accounts, get your easy marks first, We know that we've debited the bank because we've received money, and therefore we've got to credit the income received account, 21,500. Okay, we know that the opening balance was on the debit side because we did the previous accounts, but also that 1,500 is money owed to the business at the start of the year, and therefore at the start of the year that was going to be an asset. And then at the end of the year, okay, we know that we added 2,100 onto the income, so therefore it's got to go on the same side. But we can also think about it as on the 1st of the 7th, 2016, they will have an asset in the business of $2,100 because that money will be owed to the business at the start of the next financial year. Okay, and now we need to balance off the accounts. We're going to balance off at the bigger side, which is a credit side. Okay, so they should balance off at 22,800, and therefore the amount on the income statement is going to be 22,300, and that's going to be the same as we've already calculated. Right, second example is where we've got some prepaid income. And we're going to look here because the most common one is rent receivable, where companies very often, I'm saying with houses, people that rent houses normally pay a month's rent in advance. So in this case here, if we look at this case here, the business received 26,000 in the bank, and then it was found at year end that $2,000 of that was actually rent prepaid for next year. So we've got $2,000, and because it's part of this year's amount of money received at the bank, but it belongs to next year, we need to take it off from this year's income because it gets added on to next year's income. So what we'd expect is the amount of actual income to be 24,000. So how does that look on the T accounts? Well, again, remember, get the easy marks. We know that income, we debit the bank, we credit the income account. So we put a credit entry in of 26,000. Now the balance carry forward has got to go on the opposite side. And the other way of thinking about it is that the balance brought forward at the start of next month is going to be a liability, because at the start of the next month, the business owes somebody else $2,000 worth of rent. Okay, so put the balance carry forward in. Okay, that means that the credit side is definitely going to be the bigger side this time. That totals 26,000, so therefore the amount that appears in the income statement that makes the debit side up to 26,000 is going to be 24,000, and there's no problems there. Okay, looking now at what would happen in the second year for this business. Okay, they now receive 28,000 in the bank. So doing the calculation about how much we'd expect the actual income to be, we'd start with the bank figure. We know that this 2,400 at the end of the year shouldn't be part of this year's income. So we've got to subtract that. So less the prepayment at the year end. So as a running balance now, we should be on 25,600. And then what we need to do is to think about this 2,000, which was prepaid last year. Well, that 2,000 should be part of this year's income. So what we need to do is we need to add that 2,000 money that was received last year but was part of this year's income on. And that therefore gives us a total income that we'd expect of 27,600. Okay, looking at the rent receivable account therefore, well, the first thing is the balance brought down we knew was on the credit side. It was on the credit side because the business at the start of the year owed that to the people who'd rented from them. Okay, put the bank in, no problem. Okay, and we know that the balance carry forward has to go on the opposite side to the bank because the balance brought forward is a liability at the end of the year. Income statement amount 27,600, and we balanced off the accounts. 3 questions for you to have a go at, and good luck.